everybody. Darren Hartman with American Classic Agency, and one of the types of policies that we specialize in is universal life. And you've probably heard of it. There are a few different types of universal life policies, but I want to show you a pretty general example so you can get an understanding of how universal life policy works. Again, I'm going to show you a very general explanation or a basic illustration here. So we have you right here putting money into a universal life policy. And before the money even gets into the policy, a small portion comes out for fees and expenses, just like any other financial product. However, the rest of the money goes into the universal life cash value, which is represented by this blue shaded or the light shaded box here with the dollar sign in it. And systematically, the life insurance company pulls out the amount of money it needs to simply pay the death benefit costs, just like term insurance. The small blue box, it represents the minimum amount that the insurance company says that you have to pay to be able to simply purchase the policy. Now, however, there is a bigger box here, the dotted blue line. Now, this represents the maximum amount that the IRS says that you're allowed to put into the policy. You see, you can overfund the policy, meaning you can pay more than the minimum amount that's needed. So you can actually accelerate the growth of the cash value. You want to make your cash grow quicker. That's what a lot of people do with these policies, and that's what's one of the great things about this, or one of the great features about an index universal life. And generally, and the IRS knows this, generally, anytime the IRS limits what you can put into something, it's usually because it's a really good deal. And one of the things that you really have to worry about, number two, things to take notes. One, if the limits are exceeded, meaning this dotted line, if you put more than their limit, the insurance contract or the insurance policy becomes what is called a modified endowment contract. And what that means is all of the money that you've accumulated in this cash value is going to become taxable. So you need to be careful when you're designing a policy. But of course, that is what we are here for, to help you with that. And number two, the sizes of the boxes. The more insurance, the bigger the boxes, meaning the more money you can put into it. So there's really only two things that a person really needs to determine. That's number one, that's what's the proper amount of insurance that you need. And number two, the amount between those two boxes do you want to put in. And really, that's it. And so you put money into the policy, is going to come out one of three ways, and that is tax-free cash value. Tax-free, you can withdraw money from here tax-free after it starts to build up. And number two, you can take money out through loans, or you can set it up in a way that it'll pay you a check for the rest of your life, a guaranteed lifetime income. Or the third way here is, God forbid, if you die, of course, your family is going to get the death benefit 100% tax free. Now, if you want to see an illustration of how this will work for you and see the actual numbers and the power of an IUL, please don't hesitate to give me a shout. I'm here for you. All right. So this is Darren at American Classic Agency and ProtectMyIncomeNow.com. I'll talk to you later.